your retirement is just a few years away, it may be time to adjust your investing strategy.
The shocking statistic is that by the time somebody reaches 65, 95%, they're dead broke, they're dependent on family, or they're dependent on government.
It's important that people deal with someone who has access to a vast array of different insurance companies and make sure to prove and provide that guaranteed lifetime income.
Welcome to the Retirement Architect, David Reyes. Our program is designed to not only provide insight, but to educate and to give you the tools you need to help you design and build a rock-solid retirement.
Wow, what a couple of weeks we've had in the stock market. It's been basically in a breakout territory. And, that's very exciting for a lot of people. But, I really want to talk about the question today of, is this a great time to buy? Or are we in the midst of another advance in the bull market? Or do we have a tired market? Or do we have a tired bull market? It's one of those things. Is the glass half full or half empty? It depends upon, the eyes of the beholder. And I think it was Harry Truman that one time said, I wish I had a one-hand economist, because on the other hand, right? So there's always two sides to the coin. There's always two sides to the story. But I can tell you historically, we've only been in this territory a couple of times. The length of this bull market is definitely long. We've only had a couple of times when it has gone longer. And most of those times it's not ended very pretty. And I want to share with you some facts today that I think can help you for your own portfolios and your own insight to chew on. The broad stock market, the Dow Jones sitting around and the S&P around record territory. There's just one problem, and this is a big problem. Fewer and fewer individual stocks are actually participating in the rally. To give you an example, and this is measured by stocks that are reaching 52-week highs. When we had our market high in December, we closed at record highs on December 31st, 2013. We had 119 of the 500 S&P 500 stocks were at their 52-week highs. Today we have 25, and the market's now about 4% higher. That's called the divergence, okay? And divergences in markets are not good. Now, it doesn't mean the market's going to crash tomorrow, but it means you need to pay attention. So that's a number that we generally want to look at pretty hard. So when you have a smaller number of stocks hitting new highs, it suggests the participation in the run-up is starting to wane. And unfortunately, this is worrisome because this is the same thing that happened in 2000 and 2007, the last two times the market peaked. Another area of concern is that this market's advancing on very low volume. So think of it, kind of as horsepower. As the market's going up, and there's less and less participants and less volume, a little less gas in the tank. That's another sign, another divergence in the market. So that's kind of two major divergences. Number one, only 25 stocks in the S&P 500 are hitting all-time new highs as opposed to 119 stocks of the high of 2013 when the market was up 30%. And one that's definitely a big one is investor sentiment, crowd sentiment. There's an old saying, the retail investor is the last one to the party. And unfortunately, you're seeing signs of that again. Despite the talk of investor confidence being low, that sometimes investors talk one thing and do another. It's just human nature. We say one thing and do another. We vote, we say we're going to vote one way, we vote another. Sometimes it's very personal and private. And there's a neat article that I was reading, and they were talking about the combined average daily revenue of E-Trade, Charles Schwab, and TD Ameritrade, and it rose 24% in the first quarter from the previous year and has reached the highest record ever, according to Raymond James financial analyst Patrick O'Shaughnessy. So this is something that concerns me. So these three issues, and investor sentiment is a big one because generally the retail investor is wrong. Not always, but I will tell you there are studies out that a Dalbar study that is an organization that ranks retail investors' rates of return versus the S&P 500, and generally the average investor earns about 3 in the market, closer to 10. So, that's not a good thing. It's kind of like chasing return. So basically what happened, and not to mention, is that the U.S. equity mutual funds are actually getting net inflows for the second year after 6 years of withdrawals. So during this bull market, you've seen most of the investors have not participated. Now in the last 24 months, you're seeing net inflows into stock mutual funds after 6 years of outflows, withdrawals. And that's at the top of the market. It's in the middle of tapering that's going on with Janet Yellen. We're now at 45 billion. We were at 85 billion. And I'm an optimistic guy. I'm not a pessimistic guy, but I'm here to protect you from yourself, from the markets. And so if you want to give me a call and take advantage of what we call our second opinion, where we're actually review your portfolio, review your taxes, review your estate, everything that you have, give us a call at 877-406-CALL, 877-406-2255, and just make sure that you're positioned properly. I was meeting with a client on Friday, actually, and they're in their early 60s. They're about getting ready to retire, and they're 80% stocks right now, okay? 80% stocks. And I'll tell you, the average retiree during the last crash in 2008, 2009 was about 75% stocks. Retirees, and this person is basically now a retiree for all intents and purposes. They're retiring this year. So you got to be really careful. We don't want to see, if you can handle another 50% drawdown or 30% drawdown, I'm not saying that's going to happen, but the point is we want to make sure you're positioned properly to deal with that and have proper risk management of your portfolios, which is what we focus on first. Our clients have won the game. We say this all the time. And what I mean by that is most clients of ours have already amassed enough assets to retire or are retired, but they don't really have a plan, and that's the first rule of thumb. Let's have a plan. So if you want to take advantage of our second opinion and make sure that you're positioned properly and that you have a plan, all of our clients have a written retirement distribution plan, a written financial plan. Give us a call again, 877-406-CALL, 877-406-2255. That's 877-406-2255. You can always visit me on the web at reyesplan.com. That's REYESPLAN.com. And this show, we're going to talk about lots of things, how to protect your portfolio, how to make sure you don't run out of money during retirement. What is real risk management? Most of us don't have true risk management in our portfolios, and we want to ensure that you do. So stay tuned. We're going to be talking about don't wait for the disaster to strike. You want to be proactive with your portfolio. So we'll be back in a few minutes. It's David Reyes, your financial architect, on AM 760 KFMB.
You're listening to the Retirement Architect, David Reyes.
Oh, really? A professional man.
We design and build retirements that last a lifetime. The Retirement Architect, David Reyes, will continue next.
Have you recently changed jobs and now you have a 401k or other retirement account you don't want to risk in the market? You've worked too hard to leave your retirement to chance. Since you'll probably start another retirement account at your new job, why not make sure nothing happens to your last one? David Reyes with Reyes Financial Architecture can help you roll over your retirement account from your previous employer and give you principal protection from market risk. Be confident of your plan. Call Reyes Financial Architecture now and ask about receiving a complimentary review. Don't leave anything to chance. Call David now at 877-406-CALL. That's 877-406-2255.